All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Khouri, financial planner, green thumb, husband, and just dad. As a financial advisor, one of the top questions I get is, where should I invest my money? How do I invest? A share's good. A share's just gambling. And for that reason, I thought that the perfect person to invite onto the show to talk to about this exact thing is Clint Abraham. Clint is an investment specialist at Morningstar. He sits on the committee, well, a few committees actually, where he helps decide essentially where Morningstar invests money. So for a living, this is literally what Clint does. Clint, thank you so much for joining us.
Hi, Michael. Thanks for having me on.
Yeah, no, it's such an exciting topic, and I think we're talking about it in such an exciting time as well. And I don't know if it's something that you've noticed, but since recent market, depending on when someone's listening to this episode, but whenever there's market fluctuations, people start thinking about investing, whether it's something that they've been doing for a while and they've worked out they need to now do it differently, or if it's something that they've never actually done and they've actually seen other people make some money, I think, wow, maybe that's something I should be doing. Is that something that you've noticed?
Yes, definitely. And I think the thing that's worth highlighting just at the moment is that with this period of COVID uncertainty, we've seen some extraordinary movements in share markets. So when share markets first fell around the time when COVID was declared a global pandemic, the major share markets fell between 30 and 35%, which is a really significant fall. But since that time, we've had a remarkable recovery. We've recovered those losses and we've gone on to make some very new significant highs from that level. So it has been a fascinating time in financial markets for sure.
And when it comes to markets itself, and if we can even start at the basics as to what a share actually is and what are different ways of investing into shares.
Yes, of course. So a share, as the name suggests, gives you a share of a company, and that entitles you to a share of its profits, which are typically paid out in the form of dividends, which listeners may be familiar with that term. So periodically you'll get some money in the bank as a reward, if you like, for holding a share in that particular company. And we can buy shares in some of the companies that I'm sure your listeners will be using day to day, if not week to week. Many of the big companies in Australia are listed. So the big four banks, for example, we could go and buy shares in them if we wanted to. BHP, Telstra, Woolies, some of the real who's who of Australian business are listed on the Australian Stock Exchange. And that actually extends right around the world. Some of the companies that we might use in our everyday lives, perhaps Apple products or whatever it might be, we can go and buy shares in those companies as well. So it really does open up an enormous opportunity for us as investors, because when we buy into these companies, we are doing so on the expectation that they're good companies and they're going to continue to grow and pay us dividends over time and obviously help us to achieve our longer term goals as investors. We can invest either by buying individual shares like I just described. So we could effectively go to the ASX via a website, online trading or what have you, and we could engage we could buy an individual share in that company with a minimum of $500 invested. But what we can also do as investors is we can either invest in a managed fund. So again, listeners may be familiar with this term. It's effectively where a fund manager will buy a bunch of shares on your behalf in different companies. So if I stay with my example that we were just talking about before, we could perhaps buy into a fund that in turn will buy Commonwealth Bank or BHP or Telstra or whatever it might be. And so that's a really effective way of investing, because it means that we can get investments across many different companies and potentially we can have a professional fund manager look after that on our behalf. Now, the other term that your listeners may have heard of is an exchange traded fund. So that's like a managed fund, but it's listed. So just by buying one security, we can get access to a whole range of underlying securities, whatever they may be. Again, they might be those same companies that I mentioned before, or they could be something different. So there's quite a number of ways that we can look to invest. And again, a lot will come down to individual preference and individual circumstances, what investors are trying to achieve.
And as well as that, I mean, for those that haven't heard of Morningstar, could you briefly just explain who Morningstar actually are? Because they're a fund manager and they're also a research house.
Very much so. Morningstar's a very significant independent financial research data. We do a lot of investment software, as you touched on. We're also manage money, which is the part of the group that I represent today. Headquartered in Chicago, roughly around about 8,000 employees globally, and we manage around about 250 billion US dollars. So very significant business, and I look forward to sharing a little bit about how we think about the world and how we value markets and so forth.
And also on that note, so as a research house like Morningstar, there's different investment processes, or there's different, I guess, philosophies that they have. And the reason I just mention this now is because when I talk to somebody that's invested for the first time in shares, for example, by themselves, it's normally something they decided to do at 11 o'clock at night after watching some YouTube videos. And they're like, yeah, you know what, I'm just going to do this. And they make money in some areas, they lose money in others. Sometimes they get lucky, or they make the right decisions, and overall they make a profit. And a lot of the time people don't. So if we can highlight why philosophy, what it is, and why having a strategy or having something to follow is so crucial.
It really is crucial. It's the foundation of how you should look at this. And you really have to have something that you stand for. Like many different parts of life, you need to be clear on what you're trying to do, because at the end of the day, share markets, they are a financial marketplace. There's all sorts of different people, investors, doing all sorts of different things in there. They have different objectives. They're trying to achieve different things. And so it's really important that you understand what you want to achieve as an investor, because what can happen is over time we can find ourselves jumping from one different approach to another. And it tends to actually be not that useful over time. It can actually cost you returns in the long run, as you suggest there. So the key thing from our point of view is understand what you're looking to achieve and what you believe in from an investment sense. And I can certainly talk a little bit more about, to give you an idea of what Morningstar believes in. And then once you know what you stand for, then you can go into the financial markets, the share markets, and identify those particular companies that meet your criteria for what you're looking for in an investment. It might be a bit, the analogy that springs to my mind is, think of if you were looking to do an investment property, and you might have a clear picture in your mind of what that investment property would look like. There might be some physical characteristics of that, of course, but there also might be some financial characteristics. You might want to get a certain yield or something like that. And share markets are no different. You need to understand the nature of the business models of the companies that you are investing in. From our point of view, we really want to understand the quality of their earnings, how sustainable their dividends, their payments to us are going to be as shareholders. Are they going to grow? Are they high quality? And then, of course, we really want to make sure that we're trying to get a bargain when we're buying those assets. So again, as I imagine would be resonate pretty well with many people on this call, everyone likes to get a bargain, and we're trying to do the exact same thing in financial markets. And that does happen from time to time, particularly when markets are very uncertain around the economic outlook.
And also when it comes to even looking at markets and valuing markets, or even valuing companies, for example, and looking at what a company's making and how it's making that money and what its outlook looks like. And I know this is something you can talk about for probably 10 hours straight, but what are some real basic principles as to what someone like Morningstar looks at, or what an investor should be looking at when they're looking at a company?
Yeah, so one of the most common ways, or generally what share market investors are trying to do, is they are trying to understand what earnings, what profits will look like for a company 2, 3, 4, 5 years out from now. And then they want to bring that back into a number that effectively prices the value of that company right now. And so if I was, say, BHP, for example, I've got a number of mines around the world. They're going to produce X tons of ore per year, and we can make an assumption around what the price of that ore will be. If we have an idea of the earnings that they're going to deliver from their various assets, we can put that into a form where we can understand what that is, what value that is in a present day sense. And then once we have an understanding of that value, we can look at the current share price that it's trading at, bearing in mind that all sorts of different people are going to be trying to do the same thing, and we can understand if we're getting a good deal to buy that investment or not. And so people will have different ways of valuing those operations, understandably. But the market's actually relatively efficient over the long term in terms of investors being able to price that accurately. There's so many people in the market, and I guess the net effect of all their different strategies is tends to get towards the right outcome over the long term.
In talking strategy, sometimes, and I guess it's like planning anything in our lives. Sometimes it's really simple, and there's a saying, I can't think of it at the moment, but it's having, is it everybody has a plan until they're smacked in the face or something?
Yes, I think that's Mike Tyson's.
Yeah, it is Mike Tyson's quote, actually.
Yeah.
So investing, when I think about investing, I think about the ups and downs, and I think about, some people in particular that come to mind straight away, where when markets are doing really well, things are great and they're feeling great. Oh yes, they're making money, and they could see every week what their profit is, for example. But then when things go bad, they sometimes get really scared. And, there's what one of Warren Buffett's famous sayings is that you should be fearful when others are greedy and greedy when others are fearful, something along those lines. And it's a lot of this comes down to the psychology, and the behavior of investing, which many people probably aren't aware of. So if you could touch on like the human emotion, I guess, in this process, and the journey somebody could potentially go through, and some mistakes maybe that somebody can make from an emotional point of view.
Yes, of course. It's so important, and it's a key part of how we think about investing. There's a lot of research in the area of behavioral finance. So it's really looking at how humans make investment decisions. And surprise, surprise, we're not actually particularly well wired to make rational investment decisions. So what typically happens is that in times of market euphoria, so when you see share markets really running strongly, we're perhaps in that vein 6 weeks or so ago, it feels like the market's going to go up forever. And as investors, we don't want to miss out. So we tend to pile into the market because we have that fear of missing out. In actual fact, that tends not to be the best strategy, generally speaking. And the reason for that is that in our efforts to get into the market, we tend to pay too much. And again, if I can give you an example that may resonate with your listeners, imagine you're at an auction and there's 10 or 20 different parties that are all bidding, and the residential property market's running really hot. Well, what typically happens is you get a lot of people and you end up in a bidding war, and you end up spending much more than what you might have been prepared to, or what you thought you were prepared to pay when you actually arrived at the auction. And it's really that idea that emotions can grip us, and when that happens, we don't always behave rationally. Now, of course, the same thing happens in reverse in times of great uncertainty, and I could use the recent March 2020 COVID sell-off that I touched on before as an example. COVID has just been declared a global pandemic. It is really uncertain. The footage that we're seeing on TV, what we're reading in the paper, it's very, very worrying, and there's a lot of uncertainty around. Now, in an investment sense, typically what happens is that humans don't like anxiety. We don't like not knowing what's going on, and we tend to run for the exit. Now, when we do that, We sell at any price just to get out of the market, just to remove those feelings of anxiety. And in doing so, we lose track of what the asset is actually worth. So we just want to get out. We're not worried about the price. Now, that again happened during that COVID period, and these behavioural, what we would refer to them as behavioural biases, where we tend to act irrationally, they are very common, and they're quite, when we look back at key periods in financial history, quite often you see these situations where humans get overconfident in times that are perceived to be good, and they get extremely pessimistic in times of uncertainty. It really does feel like the sun's not going to come up the next morning. But time and time again, those sentiments, those emotions will pass, and then a more rational look at that market will indicate that people were actually behaving a little bit crazy in that environment.
These podcasts have been brought to you by Better Financial Planning Australia. To book a free 15-minute phone chat, visit betterfinancialplanning.com.au. And as a financial advisor, I can relate to that, because when things like that do occur, I get the phone calls and the text messages from clients, as I always do, when they're concerned about something. But I'll get questions like, "Hey, should I sell now? Should I quickly jump out and put my super into cash, or should I sell down these shares, or should I, basically run for the hills?" And when I have those discussions, I do that. I obviously explain the pros and cons of going down that path, and normally just after my first or second sentence, the response is, "No, you know what? I'm just gonna stay cool for a second and just sort of look at it from that outsider's perspective," because we do this all the time. We become, when we make any decisions, even buying a new pair of shoes, our emotions come into it, and we either choose something that we're comfortable with, or something we've always had, or something that makes us feel better, but it may not be the best decision for us.
Yeah, and that's exactly right. And I wanted to bring back in something that we touched on at the start of the call, which was understanding your philosophy, understanding what you believe in and what you stand for. If you don't have that in place, then it's very difficult for you to navigate the extremes in share markets when they're either really high or really low, because you don't have as solid a foundation in place, and therefore you're more likely to fall victim to some of these biases, as I refer to them, this irrational investor behavior that comes along from time to time. Again, you mentioned Buffett before about his saying, being greedy when others are fearful when they're greedy. That's absolutely something that we live by. We're much more likely to be buying when others are selling, and selling when they're buying, because we look for that irrational behavior, and we recognize that when it's there, we're more likely to be able to find a bargain. Again, people in that environment are just selling at any old price just to get out. And if we're able to identify when that's happening, and we're able to value the assets that we're buying, time and time again, that has been a source of great return. The thing about the behavior is it's much more likely to affect us as humans than when it's negative than when it's positive. So what I mean by that is there's a number of studies out there on this. If you can Google, I'm sure. It basically says that humans fear losses much more than they value gains. So what that means is that if I showed you a portfolio that went up 10% and another one that went down 10%, the one that went down 10% would typically have a greater impact on you. The numbers are anywhere between 2 and 5 times the impact as if you saw positive returns. So what that means is if your investment fell, when you saw the red ink, as they say, you're more likely it's going to trigger a behavioral response that might force you to do something. And you talked about this a little bit earlier, where you might feel the urge to just sell up and get out at the lows in share markets. And again, that's a perfectly normal response. But the challenge is it's actually not that rational. And we, as you say, we must look a bit deeper and look at the underlying situation, understand what's being priced into markets. And in actual fact, there might actually be an opportunity to buy assets, not sell as you originally thought.
Yes, and also there's I've read some research with some data to show that those that check their investments less often than most often are also more likely to end up essentially making more money.
Yes, you're certainly more likely to have what's the word, perhaps a more comfortable ride. And so what I mean by that, let me give you an example. In the US share market is down. If you were to look at it every day, the US share market is showing a negative return on any given day 46% of the time or thereabouts, depending on which time frame you're looking at. But let's assume it's around that figure. And again, if we come back to that behavioral response, we see a negative number. And invariably, it's going to be colored red because that's just how financial software works. And again, it triggers our behavioral response. So when we see negative numbers, we can, again, start to panic a little bit, maybe do something that we wouldn't naturally do if we weren't feeling that anxiety. So to your point there, if you don't check it every day, I'm not saying don't check it. Please do if you're interested. And I would highly encourage you to be engaged with your investments and understand how they're working for you and how they're helping you achieve your goals over the long term. But there's a balance. And what you can probably see here as I'm talking is that if you're looking at it every day, if you're really, you're not clear on what you're trying to achieve, it's very easy to have this feeling that you're on a roller coaster. And that's not pleasant, and it's certainly not the way to get the most out of share markets, in my opinion anyway.
And also let's say somebody has decided to invest into say managed funds. They don't they've worked out they don't want shares because they feel like they probably wouldn't know where to start. They wouldn't know what decisions to make. They probably don't have the time to sit there spending hours a day or hours a week looking at share markets and keeping their eye on it. And they decide to essentially pay a fund manager to do it for them.
Mm-hmm.
Can we touch on the real basics of that side of things? Like, for example, active versus passive investing, and just the main differences between that and what options are out there?
Yes, of course. So perhaps we'll start with the active versus passive bit first. And when you're looking at a passive investment, it just means that you're looking to replicate a particular index of shares without trying to beat that return, if I could say it that way. So let me give you an example. I could go onto the market and I could buy a unit in an exchange traded fund or a managed, or I could separately buy into a managed fund that would give me exposure to the Australian share market, just in its component weights. So I would get Commonwealth Bank is our biggest company. It makes up just around about 8.5% of the ASX 200. You might be familiar with that term, which is the main index for the Australian share market. It's the one that's quoted on the news every night and newspapers and so forth. If you look at that index, as I said, CBA is roughly about 8.5%, CSL's around 6%. You then come into BHP, Westpac, NAB and so forth, down to Telstra, Woolies and other companies that, as I said, I'm sure you would recognise. Now, just with that one investment, we can get access to all of those companies. Now, we're not trying to necessarily make active decisions around which one's going to do better. We're just having exposure to all of them. And that's typically referred to as a passive investment. And I can do that for the Australian share market. I can do it for the US share market. I can do it for a whole range of different share markets around the world, and indeed a whole range of other asset classes that are not shares, but that we can also use in our investment approach. The second decision that I can make, as you touch on there, is I can say, okay, well, I want to be in the Australian share market, but I want to try and beat the return that the Australian share market is going to give me. And I'm going to engage a professional fund manager to do that. Now, that particular fund manager will have his own or her own philosophy for how they're going to invest. And again, you would need to be aligned with that particular philosophy before you invested with that particular fund manager. So they will charge a fee, of course, and that fee is going to be higher than what it is just to take the passive equivalent. But again, we can engage in active managers right across all different countries in different industrial sectors. and we can blend them if we want to. Morningstar, for what it's worth, we actually invest across a whole range of different countries and sectors and other assets as we're trying to deliver particular outcomes for investors. So there really is a phenomenal amount of choice for those that are looking to go down that road.
And there's a comment that I get quite a bit, and I'm sure you've heard it plenty of times. But when I talk to clients about a fund manager, for example, or the difference between passive and active, and having money potentially invested, through a fund and having a fund manager attached to that, I normally get the comment that, hey, I heard that a lot of fund managers, they perform really poorly, or I've heard about dodgy companies out there, or I've heard about people investing their money and they don't really make that much. Apart from the fact that nobody has a crystal ball, what are your comments on situations like that?
Yeah, I would say, I'm sure there's horror stories that come up from time to time, but I would say that the integrity around the fund manager space is pretty strong. We're very well regulated, and investors or funds that are underperforming are perhaps doing so because the particular style that fund manager is using is not in favour right at that time. So I would say investors should go into an investment with a chosen fund manager, reasonably confident that they're going to act with integrity and everything like that. What it needs to come down to, though, is the client's alignment with how that fund manager is going to invest on their behalf, and again, it's consistency with what they're trying to achieve in the longer term. And there will be, there's hundreds, thousands of different fund managers doing all sorts of different things. And so there's going to be, not everyone can win. It's a zero-sum game, but there's going to be a period of time there where, some will do better, some won't. But that doesn't necessarily mean that it's, not a good option to consider the whole range of those types of investments if it's suitable for what you're looking to do.
And I think the main message that I would give on that topic as well is to talk to a financial advisor, because as an advisor, it's our job to look at these funds and look at what their philosophy is and how they're performing and why they're performing in that way, and to align that to a client's goals, and essentially this is what we do for a living. So
couldn't agree more.
Yeah, it's one of those things. Once you've gone through that process, you understand it. But until you've seen an advisor and gone through that process, it's such a different level of like education and even experience. I think when the drop happened with COVID, I had so many phone calls, but most people were quite relaxed because over the years I'd educate people on markets and that there's going to be ups and downs and why downs happen and why ups could happen and all these types of things. So it does help to be educated and to, I guess, surround yourself with the right people.
I agree. And the thing I would add there is from a client's point of view, you don't want to be up all night worrying about what your investments are doing. And particularly if you're in retirement, this is the time for you to enjoy those activities that you want to and not be stressed around how your investments are performing and what that means for your nest egg and your goals and all of those sort of things. So I completely endorse what you're saying there.
Yeah, well said. And Clint, if somebody wanted more information, how would you recommend they go about this? Because I know morningstarinvestments.com.au has some good resources on it.
Yes, we do that. That will obviously tell you a little bit how Morningstar invests, and I'm very happy to talk about that in more detail. But the other thing that you may like to consider is the ASX, which is the local stock exchange, the Australian Stock Exchange.
Yes.
They have a very helpful investor education section, and you can even do a number of courses there and just get familiar with the basics around investing and some of the things that you might like to look for when you're choosing the investments that are suitable for you. So I would recommend use that in the first instance. And then it's one of those things, once you scratch the surface, it leads you off into a amazing path of discovery.
It does. And I think it'll also give people that have never done something like this before a bit of a taste as to what's involved, and normally they'll either work out whether they want to continue to educate themselves and pursue this type of investing, or if they want to just call an advisor or someone else to help them out. because it isn't for everyone. It's like anything. It's like if I wanted to start building tables, and I could do all the research in the world, but if it's not for me, and if it's not something I'm good at, then I shouldn't do it.
Yeah, and that's right. And the challenge with investments is that it's very time consuming. It's my full-time job, and so sometimes people will approach it with an interest, but just find it becomes, quite consuming. And as I said, Morningstar's a massive company. I'm one of 100 that's working on client portfolios all the time. So we have enormous reach and scale, and not everyone's going to have access to those resources. Now, that doesn't mean you can't and you shouldn't be interested in your investments. I would highly encourage you to be interested and to learn about how your money's invested. But again, if it's becoming too much time, taking up too much time, then definitely look to see how you might balance that time better.
Yes. And Clint, with all our episodes, I like to finish off with a dad joke.
Oh, yes.
So do you have children? Are you a dad?
I do.
Yeah, so you'd be all over it then.
No, I'm not.
Okay. Well, what do you call a baguette at the zoo?
I don't know.
Bred in captivity.
Oh, my God.
I know. This is actually from a dad joke book that my son got me 2 weeks ago. It's called The Little Book of Dad Jokes. So it's actually not bad. So it's
that's actually not bad. That's quite clever.
Yeah. Clint, thank you so much for your time. I really appreciate it. And I hope whoever's listening to this has learned a lot or learned something about investing, and should hopefully help them to make a bit more of an informed decision when they think of, putting their money somewhere in the future.
Absolutely. Thank you for having me.
It's a pleasure. Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases, and feel free to share this episode with any friends or family that you think it might benefit. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.